previous class we discussed about the bank performance and as well as the financial statements of the commercial bank. Today we will be discussing about the Basel norms or the Basel Accords, on which the supervisory or regulatory norms of the commercial banks were based upon. Whenever the crisis has taken place or a different kind of financial crisis which affect the performance of the commercial bank, keeping those things in the mind, since 1988, the Basel committee has recommended certain things on which the commercial banks can operate in a smooth way. By that, the financial stability of the system can be maintained. So, that is why the basic objective of the Basel was to maintain the enough capital to absorb the losses without causing any kind of systematic problems in the system, and also to avoid the competitiveness conflicts in the international scenario. That means, the competition should be healthy, or the process of regulation also should be very much uniform across the different type of banks which are operating across the globe. So, considering those things, the committee has been formed in 1988, and there are 27 countries which are the members of that particular committee or particular Basel or the to form this Basel Accord. So, in this context, they have started this process since 1988, but actual the effect has come into 1992, and it was started in India little bit late, but the actual implementation of the Basel I was come to the market or has come to the market in the year 1992. So, already I told you that the basic objective of the Basel norm is to maintain the capital, enough capital to absorb the losses, and as well as to make this market competitive, but in a healthy way. That means, the uniformity in terms of regulations should be there across the countries. So, whenever the Basel I was started, the Basel I was based upon the 4 pillars. There are 4 different dimensions, 4 issues what the Basel I was trying to discuss or trying to always explore, on which the banks can operate or banks can basically be regulated. So, according to this, the first one is the Basel has given a very formal definition of the capital or the capital ratio, what in our term what we call it. Then what the Basel committee has said, that the particular capital ratio of a particular bank, or in our language we call it the capital adequacy ratio. So, the capital adequacy ratio should be always minimum or should cross a particular limit, and every bank should target that particular capital adequacy ratio to minimize the probability of failure in the future. So, that is why the capital adequacy ratio is formally basically considered as a stability ratio for the commercial banks. So, here they have defined there are 2 types of capital, one is your tier 1 capital, second one is the tier 2 capital. So, whenever you talk about the tier 1 capital is basically the common stocks. The common stocks are basically the tier 1 capital whatever the bank has, and also some disclosed reserves and surplus what the commercial banks have. So, these are basically the part of the tier 1 capital. Then whenever we come to the tier 2 capital mostly consists of the undisclosed reserves, revaluation reserves and the provisions. Particularly the provisions in the previous class we are discussing, the provisions the commercial banks made to get rid of any kind of losses what they may incur against the loans what they have provided. So, the loan loss reserves, general loan loss reserves is a part of the tier to capital which is considered for calculation of the capital adequacy ratio. And there are some subordinate debts and some hybrid instruments like the preference shares. So, preference shares and subordinate debt, these are the part of the tier 2 capital, and common equity which is a part of the tier 1 capital. These are the different definitions what the Basel I has provided, and accordingly what the bank has to do, the bank has to basically calculate the risk weighted asset. And the capital adequacy ratio in general term is defined as, let your CAR is equal to capital adequacy ratio. This is your total capital upon the risk weighted assets. The total assets, the whatever the commercial banks have, the particular assets should be given certain weights, and the Basel has given certain weights. There are some assets which have 0 risk, there are some assets which has the 0 risk. So, that is why those particular has part we are consider about the 0% weightage. Some assets have little bit higher risk than that. So, we are getting 10%, 20%, 50% and 100%. Depending upon the nature of the asset, the weights can be given to the different type of assets of the commercial bank. Then finally, the weighted average of that particular asset can be calculated, and once the weighted asset average of the asset can be calculated, that basically can be used as to calculate the risk weighted asset. So, that is why the total capital to total risk weighted asset should be always a certain, should cross a certain limit or should be equal to a certain limit. Then what is that limit? So, that is why they have defined this target standard ratio. The target standard ratio is basically the 8%. So, that means according to Basel I, your CAR should be greater than or equal to 8%, and CAR is nothing but the total capital upon the risk weighted assets. And another condition what they have said, of which the core capital element has to be at least 4%. The core capital element, in the sense we are referring to the common shares. The tier 1 capital, which is called as the core capital for the commercial bank, or the retained earnings, which is the core capital of the commercial bank, that should be minimum 4%, and the total capital adequacy ratio should be more than or equal to 8%. So, that is the first thing what the Basel has provided in this particular context. And then we have the transitional and implementation arrangements, and transitional and implementation arrangement means they are talking about the this supervision, they talk about the market discipline, and the amendments from the time to time what this particular calculation needs to absorb any kind of future losses what the commercial bank may face. So, this particular foundation was started since 1988, and after that what has happened, the implementation was started in 1992, and although this was made for certain countries, so every country was trying to follow as a guideline for them to minimize their instability in the financial system. So, then if you see that how basically this Basel occurred from to time has changed, and what are those different things which are involved in this. Already I told you that the risk weighted asset basically consists of the sum of risk weight times asset amount for on balance sheet items, and the sum of risk weight times credit equivalent amount of the off balance sheet. There are some assets which are off balance sheet items like derivatives instruments, swaps and all these things. These are all the services what the commercial banks and the valuation of intangibles and all these things which are coming under the off balance sheet items, and there are some assets already what we have highlighted, they are coming under the on balance sheet items. So, the weights are given to the respective items on the basis of these 4 categories or 4 ways, 0%, 5%, 0%, 10%, 50%, 100% like this. Then accordingly the risk weighted asset can be calculated, and the risk weighted asset should be divided with the capital to find out the capital adequacy ratio. Then after that, due to certain issues, time to time there are certain amendments were required for the preliminary norms what the Basel has recommended. So, that is why this amendment process was started in 1996 and this was implemented in 1998. And here what basically the amendments were given, you see whenever we are providing the risk weights to the different assets, the risk weights were given on the basis of the credit risk. The risk weights were given on the basis of the credit risk. The credit risk already we have defined, the credit risk is nothing but the probability of default what that particular loan may incur or particular asset may incur in the future period due to the non-payment of the cash flows to the particular commercial bank. So, the credit risk is basically a probability of default what we have to consider, or the probability of not repayment or probability of not getting that particular asset in the actual time period or in a specific time period. So, the weights were given on the basis of the credit risk, but because of the fluctuations in the market fundamentals, the banks are also exposed to the market risk. So, whenever in 1998 the amendments were made, in the amendment the commercial bank were instructed to give the weight for the market risk also. So, in addition to the credit risk, whatever weights were given to the assets, the weights basically not only to be given on the basis of the exposure towards the credit risk, the weights should be also given on the basis of the market risk. So, that is why the market risk is the addition in the amendment. So, market risk should be considered while calculating the risk weighted asset for the commercial bank after these amendments are made on the Basel I. So, then every 2 months the committee basically always sit for the discussion and try to find out that what are those loopholes, and they try to recover, they try to implement certain kind of new guidelines to make this particular system more robust or more stronger. So, in this context what has happened, the Basel II was implemented since 2007. And particularly whenever the Basel was started implemented after the Basel I due to certain issues. So, in the Basel II we have 3 pillars. So, these pillars are first of all, as per the Basel norms, whenever we are talking about the minimum capital requirements, the same minimum capital requirement concept was stayed by this Basel II. So, according to, because that is basically the stability ratio what the Basel committee has recommended. So, because of that in the Basel II they have said that the minimum capital requirement should be retained and that particular amount is basically the 8%. But only one difference has been observed. So, previously what we have seen, in the beginning the credit risk was considered to provide the weight. Second, they have added the market risk in the amendment, and whenever they have started the Basel II occurs as a Basel II norms, in the Basel II norms the operational risk was introduced. So, while calculating the capital adequacy ratio, we have to consider also the operational risk. So, that is the guideline what the Basel II committee has recommended. And your second pillar was the supervisory review process. And what is the supervisory review process? It is basically intended to ensure that the banks should have enough capital base to support all type of risk associated with the bank in the business process. Then whatever risk the bank has, the a sufficient amount of capital should be there with the commercial banks to absorb any kind of risk or any kind of instability which may arise in the future. So, that is basically the major theme of the supervisory review process. Then to make this particular system robust, then what the Basel also has recommended, the Basel committee has recommended also the concept of the market discipline. So, what do you mean by the market discipline? The market discipline is the disclosure of the bank's capital and risk taking position from the time to time to all the market participants, and it should be made public. That means, the people who are linked to this commercial bank, they should have enough idea that what kind of capital the what is the amount of capital the commercial banks have, and what is the amount of risk weighted assets they have, and what is the capital adequacy ratio of the commercial bank, and all other financial informations which are supposed to be required for participating in the investment process, and as well as the business dealing with that particular commercial bank should be made public. So, the market discipline is the third pillar in the Basel II norms. So, on the basis of these three norms, the Basel II recommendations were implemented for the commercial banks, and across the globe or across the world, all the commercial banks or the regulators of the commercial banks were trying to impose or trying to use this Basel II norms since 2007. Particularly in India also we have started it since 2007. Then if you see that what are those things basically required for this. So, here also what the Basel committee has recommended, how the capital can be defined. Here again they have written this tier 1 capital plus the tier 2 capital. Already we have explained what do you mean by the tier 1 capital and what do you mean by the tier 2 capital. So, here how the risk weighted assets are calculated. The risk weighted assets are calculated by this way. Basel has given on certain kind of guideline for this. You multiply the capital requirements for market risk and operational risk by 12.5. You calculate the operational risk, you calculate the market risk, and you multiply 12.5 to that, and add that particular thing to the sum of risk weighted asset for the credit risk. So, whenever you have, because you are exposed to market risk and the credit risk, so Basel has estimated that 12.5 should be multiplied with respect to the market risk and operational risk, and that has to be added with the risk weighted asset for the credit risk. So, previously it was only credit risk and market risk after the amendments in the Basel I, and now they have added the operational risk, and they are giving 12.5 multiplier for the market risk and the operational risk, and obviously the credit risk were calculated on the basis of the different weights which were already decided by the Basel I. Then another recommendation what the particular committee has given, the tier 1 capital to total risk weighted credit exposure should not be less than 4%. They have written whatever way the Basel I has recommended, the core capital concept what they were talking about, the core capital concept also was written by the Basel II committee, and they have according to that particular norm, the tier 1 capital to total risk weighted assets risk exposure should not be less than 4%. Then here again the capital standard or the target capital adequacy ratio should be 8% or more than that. That particular thing what they have discussed in the Basel I, that basically they have retained it, but that varies from country to country. In Indian context we have added some extra premium to that. So, that is why for India it is 9%. The capital adequacy ratio for Indian context should be 9%, because according to Basel it should be 8, but depending upon the different risk profile of the different system, financial system, the commercial banks or the regulator can impose some extra amount of ratio or extra amount of capital with respect to the risk exposure whatever they have. So, in this context we have 9% for the Indian banks, and the tier 2 capital may not exceed the 100% of the tier 1 capital, which was not there before. Then whatever capital base we have, the tier 2 capital and tier 1 capital may be equal, the amount of capital may be equal, the different types of capital what the banks have, but it should not exceed 100%, or the tier 2 capital should not be more than the tier 1 capital. So, because tier 1 capital is the actually the safe capital what the banks have, because this is their own money, their own return earnings, their own equity, and whenever we are talking about the debt, subordinate bonds and all other things, that basically is not the owner's equity what the commercial banks can use whenever they want. So, because of that at any point of time the tier 2 capital should not exceed the 100% of the tier 1 capital. So, that is the extra recommendation whatever they have given whenever they have started the concept of the Basel II. Then after that basically what has happened, that other pillars already I talked, I told you that this is the supervisory review process and market discipline. So, under the supervisory review process, what they have said, the banks should have a process for assessing and maintaining their overall capital adequacy ratio. Then the supervisors or the regulators should review and evaluate the bank's internal capital assessment or capital adequacy assessment and the strategies. Whatever strategies these banks are adopting to maintain that capital adequacy ratio or to smooth operation of that particular bank, that also should be always reviewed or evaluated by the regulatory bodies or the supervisors in that particular system. And the supervisors should expect banks to operate above the minimum regulatory capital ratio. It is always ensured that the minimum capital adequacy ratio, already we have discussed, that is 8%, but the regulator or the supervisor always should ensure that every bank has minimum 8%, but it should be more than that. And already I told you that for Indian context it is 9% or can be more than that. So, whenever we talk about the at any point of time, they should always ensure the capital adequacy ratio should not go below, and if there is any possibility that capital adequacy ratio can go below, then the regulator or the monetary authorities can intervene into that to make this particular ratio to a particular level. By that, the risk profile of the commercial bank can be maintained. So, the purpose of the pillar 3, which is the market discipline. The market discipline is basically your pillar 3. So, market discipline is to complement the pillar 1 and pillar 2, because if there is no discipline, then or there is no such kind of market discipline will be imposed on them, then what will happen, that the commercial banks may not be able to sustain that minimum required amount of capital adequacy ratio what the Basel committee has recommended. So, therefore, they have to they said according to this norm, they should disclose all the requirements to assess or to allow the market participants to understand or to assess the information about the bank's risk profile and level of capitalization. What kind of risk the bank is facing, and how much capital the bank has, and whether this amount of capital is good enough to absorb the shocks or absorb the losses if there is any because of exposure towards the risk. So, all these things are basically always done by the through this market discipline. So, time to time the market discipline concept or market discipline guidelines may change or the regulatory policies may change, but the basic objective is to ensure that at any point of time the capital adequacy ratio should not go below the 8%. So, that is basically the concept of the market discipline in the context of the Basel II norms. Then Basel III, the operation was started since 2010, but it was scheduled to introduced in 2013, particularly in the Indian context. Some of the banks were complying with that, or some of the banks may not be, although it was started in 2010 and 11 and was scheduled to be introduced from 2013, but India also is trying to adopt the Basel III, but there are certain kind of regulatory norms which were started in the concept of Basel III. We will be discussing certain major points what the Basel III is trying to explain, or what kind of new changes which have taken place whenever the Basel III norms were started. So, here the basic objective of Basel III was to absorb the shocks arising from the financial and economic stress, and to improve the risk management and governance of the commercial bank, and to strengthen the bank's transparency and the disclosures. So, these are the major objectives of the Basel III. So, keeping these objectives in the mind, Basel III has talked about certain things. One is they have introduced a much stricter definition of capital. Better quality capital means the higher loss absorbing capacity. So, that is why they have given much focus on equity, and they have started a concept of capital conservation buffer, which is above this regulatory norms, that is 8%. So, that is why the banks have to required to hold a capital conservation buffer of 2.5%, which is above this regulatory norm of 8%. And this would also have a counter cyclical buffer because of changes in the market fluctuations and all these things. So, the buffer can range from 0% to 2.5%, which should consist of common equity or any other instrument which can absorb the full losses if there is any in the system. So, overall what basically we are trying to say that over and above the 8% of capital adequacy ratio, there are certain other buffer capital ratio or buffer capital has to be maintained by the commercial bank to absorb any kind of losses due to the cyclical changes in the economic system and other kind of risk what the commercial banks may face. So, another thing they said also the minimum requirement for common equity, which is the highest form of loss absorbing capital, has been raised from 2% to 4.5%. That amount of equity, mandatory equity capital has also increased to 4.5% according to Basel norms. So, that means above the 8%, at least 4.5% should come from tier 1 capital and mostly from the equity. Then they have said that there is a leverage ratio. So, leverage ratio is basically what? It basically is the relative amount of capital to total assets, not the risk weighted asset. So, 3% leverage ratio of tier 1 will be tested before a mandatory leverage ratio is introduced in January 2018. So, that means the capital ratio also should be at least 3%. The capital ratio means you are not providing the risk weights, the total capital upon the total assets. That should be a minimum 3% of the total capital what basically the Basel III has introduced. Then as part of the macroprudential framework, systematically important banks will be expected to have loss absorbing capacity beyond the Basel III requirements. And another important thing what the Basel III has said, they have added the concept of liquidity risk. So, on the basis of this what they have defined, they have basically given two definitions of liquidity risk to measure the liquidity risk, that is your liquidity coverage ratio and net stable funding ratio. And if you see the net stable funding ratio is nothing but or the it is a defined a proportion of capital and liabilities expected to be reliable over the time horizon, and the amount of stable funding required, that means the amount of funding, actual funding available, stable funding whatever the banks have divided by the required funding, that is basically we call it the stable funding ratio. It should be greater than or equal to 100%, what the bank should always ensure. And the required stable funding is a function of the different other liquidity characteristics or different kind of asset what the commercial banks have already have. And liquidity coverage ratio is the ratio of high liquid assets to the total net cash outflows over the 30 calendar days what the commercial banks have. That means the liquidity, enough liquidity the commercial bank has to maintain to fulfill the requirement of the customers in the short period of time. So, liquidity risk is an extra concept which was added in the Basel III. So, if you compare the Basel II and Basel III, there are certain differences. Minimum ratio, if you see here it was 8%, now it is 10.5%, because there are some buffer capital you should have. Previously this common equity to risk weighted asset was 2%, this was become 4.5%, but this can also change up to 7%. Tier 1 capital to risk weighted asset, it was 4%, it has become 6%. Tier 1 capital to core tier 1 capital to risk weighted asset was 2%, it has become 5%. Capital conservation buffer was not there before, but it has become 2.5% now. Leverage ratio was not considered, now it is 3%. Counter cyclical buffer, it is 0% to 2.5%. Minimum liquidity coverage ratio was not required according to Basel II, but it was there in Basel III. Minimum net stable funding ratio was not there in the Basel II, but it was there in Basel III. And systematically important financial institution charge, it was not there in the Basel II, but this was a new feature which was added in the Basel III. So, these are the major differences what basically we have observed in the Basel III norms. So, what here what basically we have discussed, this is the overview of the different norms Basel 1, Basel 2 and Basel 3, and we are just briefly discussed about that how these particular norms are basically implemented and or may be designed for the betterment of the commercial banks to manage their risk or to increase their sustainability in the market or to make this particular financial system more stable or to capture or to absorb the probability or expected losses what they may incur in the future. So, next class we will be discussing about under these norms how the different type of risk basically are measured. So, how the risks are measured, different type of risk like credit risk, liquidity risk, your market risk are measured and what are the different methods are used for this. Please go through this particular references for this particular session. Thank you.